Okay. So start? Yeah. Okay. Ladies and gentlemen, good day to all of you from wherever you join us in this interesting oil trading as part of Energy Trading Week. I am Hassan Al Alawi. I will moderate today's panel. I have over 28 years experience in project management, project finance, capital market, merger and acquisition, risk and business continuity management gained from various positions. The panel addressing risk management in oil trading, navigating volatility. We aim to understand how to manage oil trading risk in the context of high price volatility, explore strategies that have been put in place to manage such volatility, how to optimize margin management, and what tools are available that used for better cash management. It's a 45-minute discussion that we hope will be interactive and beneficial to all participants. We encourage the audience to ask questions, and I will cover some of the questions during the panel where possible, otherwise at the end of the panel. We have with us three experienced speakers, Pierre Lebon, Samir Soleja, Muneeb Ahmed. In a few minutes, I kindly request each panelist to give a short introduction to themselves and their interest in the topic, starting with Pierre, Samir, and then Muneeb. The floor is yours, Pierre.
Thank you very much. Hello, everyone. So I'm Pierre Lebon. I'm the director of analytics at Sequant.io. I've got 16 years of experience in the valuation and risk management industry in the commodities area. And Sequant is a SaaS analytics platform for energy portfolio. With our team of quants, we service highly demanding clients in the area of energy and commodity management.
Thank you. Samir?
Hi. Yes, hi, I'm Samir. Samir Soleja. I'm the founder of Molecule. We are a cloud ETRM, CTRM company. I've been in the industry for about 22 years at various other ETRM companies before starting Molecule. And, I'm glad to be here today. Volatility is something that all of our customers are trying to manage with our software. And it's something that we stare at every day.
Great.
Hi, everyone. My name is Muneeb Ahmed. I am the Director of Trading and Logistics at Avfuel Corporation. Avfuel Corporation is a global aviation fuels and services company. We have over 5,000 fueling locations around the world, and managing risk and volatility is what I handle here, and it's been a very interesting year. We're looking forward to sharing some of that in the next 40 minutes.
Great. Yeah. Thank you all. Now let's kick off the panel. Now, as I mentioned earlier, we aim to learn how to manage oil trading risk in the context of high price volatility. Nonetheless, with the recent geopolitical conflict, someone may find it so difficult to stand in front of such unprecedented price volatility. So the question for our esteemed panelists, soliciting your views in a couple of minutes, please. To what extent have the current ongoing geopolitical, between brackets, Ukraine-Russia conflict mainly, uncertainty impacted oil trading and business? Yeah, we can start with you, Pierre.
Yeah, so effectively, all commodities, energy commodities have been impacted. What's interesting is we have seen that oil prices are now sort of stabilizing around $90, $95 a barrel. And these price levels have been seen in the past. They are not, from a pure price level perspective, unseen. Volatility as well has been sort of experienced to these levels. What's very new is the relationship and the dependencies of all the other commodities like gas and electricity to the oil prices. So approaching this from a modeling perspective, we can still rely on legacy, I guess, models and statistical models to distribute the prices along the forward curve. And the challenge that people are facing these days is, what types of scenarios should we, shoot for when we want to do proper risk management, right? Good risk management practice would involve defining several scenarios along which you distribute the prices so that you can have a distribution of possible prices. And these are the current challenges, because no one knows if tomorrow's oil is going to be flowing as it should, or if there's going to be shortages in the markets. That's the uncertainty, and it is embedded mainly in the future of the prices.
Great. What do you think, Samir?
Yeah, I mean, I think to what Pierre said, we are seeing real questions about, real risk management metrics that have been sort of ignored for a while. How do you do your VAR? Oh, well, what if I would like to twist the value at risk computation this way? Obviously, KYC is starting to become important, even on our part. Is there a question of which companies we can do business with and which ones we can't? And that's a real one for us, and obviously for our customers as well. Lots of new fuels companies coming online that we see. And so they need things, as they need systems as they start to try to navigate volatility. They need to consolidate data as well. And then lastly, new valuation models. This is a little older, but I remember when the price of oil went negative for a couple of days, and well, let's just say Black 76 doesn't support that. And so there were people scrambling, including us, to try to help our customers with the modeling that they needed to do.
Yeah, great. Muneeb?
Yeah, I'll highlight a little bit of, give a little bit of context, sort of maybe might help our viewers to understand pre-invasion and post-invasion, right? What has really changed? I mean, if you look at, oil fundamentals, the West was importing 5 million barrels a day pre-invasion, right? Pre-Russian invasion. And now that is down to 3.5 million barrels per day, right? In that 1.5 million barrels a day, not all of that was lost, right? But certainly some of it was lost because of efficiencies that had to be rerouted. So that's huge, right, for global oil supply and demand. And so it totally threw the oil markets out of balance in a way that we haven't seen before. And then maybe the only other time that we can, sort of make an analogy that, something similar happened from a supply standpoint, or, the opposite that happened in 2014 when a lot of supply. And so, now we're looking, we have, now, so the summer, everything has been super volatile because now it's all very policy and geopolitical driven. We don't know when, how the Russian embargo, if that goes through, that puts the rest of that 3.5 million barrels per day at risk, right? And so that could be another game changer, and that could be huge on oil. That could be extremely bullish on oil prices. But then, there's a bearish argument to all of this too, because as prices go up, people kill their demand. Europe is actually is already starting to kill demand artificially, right? Whether it is taking away the heat from saunas around the public pools, closing down factories because electricity prices are too high, right? So the market is adjusting to all of this, and so that makes for some bearish scenarios too. And so this volatility is extreme, and we could see this in options prices. We could see this across the curve, right? And so when we think about risk management and volatility management, right? I mean, there's a ton to think about. What from an organization standpoint, leveraging softwares to make sure our positions are correct, and making sure that and not just that, making sure the risk modeling is actually way better, where we're not relying on the standard VAR models, and then really stress testing the book to see, because these days margin calls could actually kill companies, and that's one of the biggest that's been one of the biggest challenges for companies around the world.
Okay, great, Muneeb, thank you. And I know that talking about the impact is probably will be endless, because of obviously it's high, if not extreme, as it can be lived and experienced on a daily basis. So thank you. Moving back to the agenda and starting with Pierre again, what strategies have been put in place in face of price situation? What we need to understand is how is the coordination between front office, treasury, and back office done?
Yeah, so I think actually speaking from a risk management software perspective, these parts, I guess, the middle office has been seen as the day-to-day routine of, okay, I have my model, I run my report, and on a daily basis, I see that prices move and they stay within comfortable price bands. And yeah, sometimes they're higher, sometimes they're lower. I think nowadays the challenge is going to source tools that are, first of all, technologically very competent and new to adapt to software as service, on-demand analytics, really ways to procure results very efficiently and quickly, and then disseminate that throughout front office, middle office, and then all the way to back office. So that's the challenges that needs to be addressed. And the strategies to do this, again, from a quantitative perspective down to the reporting side of things, is to try and see what we can salvage from the old times of, the pre-invasion statistics that we observed in the prices, and overlay that on top of, some fundamental analysis going forward. So having models enough to marry together the future price curve that would come from fundamental analysis. So, and then marry that with the volatility calibration correlations, which could still be pertinent and useful today. So these are the challenges to be addressed, especially on the software side of things.
Okay. And Samir, what are your tips in that?
Yeah, I mean, I think where in years past, mid-office was looked at as, hey, they're the group that allows permissioning of new instruments to be traded. There's a process. Opportunities are happening really fast. And I think right now, mid-office is probably more reacting to the opportunities and trying to just keep the data and keep the positions straight. This idea of 6 weeks to support a new market is just not fast enough. We had a customer call us yesterday, letting us know they were turning on a new market this morning, and we had better be ready. So that's really the more normal state of affairs here, because these opportunities are happening fast and all over the world. And so I think that's really interesting. And then also trying to keep a single version of the truth between front, mid, and back office is sort of table stakes, but it is still very hard. We had a customer recently who was struggling to figure out the impact of interest rates on option valuation models between front, mid, and back office systems. And that's just a thing nobody's paid attention to for 10 years. And now it's really becoming a thing.
Yeah, and I think to that extent, anything that is oil indexed nowadays, needs to be taken care of even more carefully than before, right? So inclusion of interest rates, but also, if you've got any deals which are indexed to some averages of gas and a mix of energy commodities, you really the need to identify the primary drivers of the portfolio risk, if it's embedded in these types of contracts, is quite paramount to managing the portfolio risk as a whole.
Which, just to add to that, Pierre, is really a function of understanding the native position of the organization, right? I mean, it's not necessarily just trades anymore. It's what do we do? What do we care about? Sorry, Muneeb, I think I stepped on something you were going to say.
No worries. I was actually just going to highlight, I think what you said about, what Samir said about single version of the truth. I've seen this in many organizations, and it is, especially, when the accounting system is not aligned with the trading mark to market, that's when there's the biggest discrepancy. Of course, if the whole company follows mark to market, even then there's discrepancies, and not just that. Again, as Pierre and Samir highlighted, more and more, right? As there's real impact, real noticeable impact on cash flow from margin calls and the like, this is starting to come way more into effect.
Okay. There's one question that I guess it fall within the points that Muneeb, you might take that. It says static dead inventory valuations impact the box in the current environment. Is it advisable to hedge these valuation or live with it as it doesn't impact the cash flows if valuation of products is aligned with the crude pricing on macro basis?
Yeah, and the answer to that is very complicated, and it depends. It depends on your company. Cash flow might be super important to you one day, and net worth might be a lot more important to you the next day, right? So really, hedging, it's hedging your net worth, right? The value of your inventories, for example, if you have a bunch of inventories. But when prices go up, right, it has an impact on your cash flows, no matter what. Because prices go up and it's offset by the hedge, but then you sell the barrels, but then you have to replace those barrels with expensive barrels as well. So it's on the way up, it's a huge cash flow, cash out play. And so I think, again, it depends on a company's risk strategies. It depends on what is important to them at that point in time. And I think for anyone who is looking to sort of go right in the middle somewhere, I would advise to look into options, right? If let's say you have a bunch of inventories and you short, you play, your general default is to short futures against it. I would say buy call options out of the money, right? So that you at least have this limited downside on your cash flow. So, whether it's 20 million you can live with, that's for every corporation to understand and decide themselves.
Okay. Thank you, Muneeb. There's another question before moving to the next item of the agenda, and probably Samir, back to you. What are the biggest demands of risk technology these days?
Yeah, I think the thing that is the most common that we hear all the time is everything in one place. Whether it is a refinery that needs its feedstock forecasts in the same place as its mark-to-market valuations, or whether it's, somebody trading some other commodity who needs to understand their inputs and outputs as well alongside their actual trading activity. As we talk to more and more folks in the industry, I think It's been sort of standard to model each of those things as a trade. And in some cases that doesn't really fit because those aren't trades. They are positions that people have. And so this need to see everything in one place, a lot of people accomplish this with a data lake or some other ELT stack. It seems to be a growing need.
Okay, good. Pierre, do you want to add anything on this question?
Yeah, I fully agree with Samir. I mean, and you can't necessarily have one size fits all system because, you know, different systems could be good for different types of commodity. And the needs emerging from the customers, from the market, is definitely centralized around being able to manage the various data flows and having the newest technologies around that, you know, having, you know, APIs to manage the data and not having to go through very painful and lengthy integration processes to achieve that. So that, you know, you can then and end up with this centralized reporting place for your risk management.
Okay, great. Thank you. Now moving to the next item in our agenda. Now, starting with Samir, how do you optimize margin management in general, as I will move later on to tools in the next item?
Yeah, I mean, this is something that we've been looking at hard and is a struggle, partly because there's so many different margin models in use. You know, heaven help you if you want to implement a span margin calculation, but a lot of people use that for their trading. But now we're also seeing that certain exchanges are moving away from span as well, which means you need that model running too. And then when it comes to bilateral margining, I mean, again, these are all bespoke proprietary models that people are running, and optimizing them. Well, I think that's probably an answer for Sequant and Pierre's firm. We simply record and take the output of the fixed calculation.
Yeah, okay. and sometimes even the exchange have difficulties coping with the so rapid movements along the prices, and they have troubles just reporting to, you know, the people trading on the platform about the margins, and the people turn around to companies like, you know, analytics platform like ours and say, look, I need to be able to report intraday for my margin calls because I don't get any information before, you know, few hours or several hours after the close of trading. And then we need to provide that to the client and develop tools to help them being able to, you know, have not just an end of day margin call because it could be so huge that it's almost too late to do something about it, but also having the ability to have an idea about intraday, how this margin call is going to look like at the end of the day. Yeah.
Okay, and Muneeb, what do you think?
Yeah, I mean, it's again, as I think Samir and Pierre touched on, it's a very tough environment, right? Managing, I mean, margin. I think we're talking about sort of maybe margin call here, but also you know that which then feeds into company margins. But I think managing that is by and large staying on the same page with treasury, right? Staying on the same page with your back office and the middle office. I think having a way to communication I've seen is actually probably the biggest challenge and the biggest advantage in situations like this, where when everyone in the corporation is aware of things, you know, surprise margin calls coming up, as it turns to not be a surprise, it just helps things to go much more smoothly.
Yeah, okay. There's actually, I got a question from one of the audience. How do you move from reactive to proactive approach for handling a new line of business? Who would like to take that first?
I can start.
Yeah, Samir, go ahead.
Just building on what Muneeb just mentioned, communication, right? I mentioned we got a call from somebody saying, "Hey, we're starting in a new market tomorrow, FYI." That's fine. We were ready to support them, but the truth is that mid office, back office, front office, treasury, everybody needs to be communicating about new lines of business because in an era of high volatility, that could be a company bet as opposed to a small bet.
Yeah. So the tip is communication from your side.
Absolutely.
Yeah.
I come from a quantitative background, so I tend to think of these problems as a quantitative analysis problem, and I think new line of business may need new valuation tools and methodologies, and this is probably the types of things that needs to be anticipated when opening these new lines of business. You don't want to have to wait for your middle office to have the proper tools to be able to risk manage. Because the worst nightmares of the front office traders is that they can't start this new line of business because they are told, oh, you need to wait for the middle office to have something to risk manage the portfolio. So anticipating the needs of the specifics of the new lines of business that you're entering into is probably key.
Yeah. Anything to add, Muneeb, on this point?
Yeah, I would just add very quickly. I think again, it's sort of being proactive in this. I think it's in the question. It's really when you're even setting up something new, or even just starting something new. Just I think having a roadmap of what other possible lines of businesses you may or may not enter into. Just thinking about that and highlighting what those exposures are would allow you to set up those instruments at the outset, which is way easier than later on, right? Once you have a system in place, whether it's an Excel file or a sophisticated software, right? Everyone is used to that system of recording. And then when you introduce a completely new instrument, which has to be maybe inputted manually or whatever the case is, right? It throws off the entire system. So I think, I would just recommend, what in any business, think about what the potential exposures might be, what potential exposures you might want to offset, or in any case, right? It's not just financial instruments, but for anything in particular, organization at the outset is definitely beats messing up a system when it's fully in place.
And I fully agree with you, Muneeb. And a good example of that is the renewables energy space, where there's a huge amount of new entrants going and tackling this new line of business without the tools. And I think what is key, and what I'm hearing from the market, is these people really want fast to implement tactical tools to get the new line of business going.
Yeah, okay. Yeah, so I can basically summarize those points into moving from reactive to proactive communication, proving tools, methodology, roadmap to list all the challenges. Probably those are the main things. Okay, now let's move to the next item. We have a couple of questions. I'll come later into those. The next item of the agenda is, okay. It's centered around basically the available tools that to deal with such situation. What tools are available for a more accurate real-time evaluation of exposures, allowing for better cash management? So we can start with Muneeb this time.
Yeah.
What are the tools? Yeah,
I would say, it's tough to say sort of one tool, right? Again, whether you're trading or hedging, managing risk, again, I've been in some groups that have done all of this on Excel sheets, right? And I've been in other groups that have done this using sophisticated software, right? No doubt, sophisticated softwares are the best, right? Because you don't have to spend 10% of your day in managing or not just managing the position, and entering the position, marking the position, and then reporting the position, right? Because usually, I'm sure softwares like Molecule and Quant, they, integrate, again, the front office, mid office, and the back office. Whereas before, if you're doing all this in Excel, it requires a lot more communication, a lot more, just it's a little less efficient. So if I say, what are the tools that are required? One is even not looking at the tools, it's a good process that is required, right? A good process for having, I saw a question, someone was asking about FCMs. Whatever the case is, having a good process for executing positions, for centralization of positions, because, again, there's a million and one ways you can trade. You can trade on CME, you can trade on ICE, you can trade on, over the counter, and all of a sudden positions get all over the place, right? Having maybe one central FCM or clearinghouse to central all your positions is one idea, right? And then again, from that, integrating it with some sort of tool would definitely help. So that would be my take.
Yeah, great. Samir?
Yeah, I'm, just sort of building on that. There are modern and less modern versions of each of those, everything from an FCM to an exchange, et cetera. And finding ones that work together, it can be really helpful, because for those, it could be just the flip of a switch and, oh, okay, that's integrated. That's one less step I have to worry about. And then what we've seen downstream is, as people are starting to put together, data lakes, essentially, just areas where there's lots of pre-transformed data, from forecasting to position management, even to financials. There is tons of great tech that's come out of Silicon Valley that can help with that. On the data storage side, everything from Snowflake to Postgres. I know people are very excited about Snowflake these days. Internally, we use Postgres. It's just simpler. And then there's some great loading tools like Fivetran and Airbyte, which will just pump data from one system to another without you having to worry about it. And then from transformation in 2022 is totally different than it was 10 or 15 years ago. There's a starting to become standard set of open source-ish tooling called DBT that is amazing for data transformation. And then there's all sorts of BI, any BI that you can think of, everything from Power BI on the Microsoft side to Mode Analytics and Metabase, which is what we use at Molecule. So I guess all that to say, there's great tooling that's come out of Silicon Valley for the purposes of mining and consolidating data from all of these hopefully pre-integrated systems.
Yeah, and I agree, and I definitely observe a lot of the market expectation nowadays is not to have very complex tools to use, but everyone wants to get to ways to analyze data in a very intuitive ways with tools which are a lot more intuitive than they were 10, 15 years ago.
Yeah. Okay, great. Yeah, there is a question that we can take in here. It says, with increased volume, increasing capital requirements, and interest rates increasing, is there a move to FCMs away from sleeving?
Sleeving as in bilateral credit, perhaps?
I guess, I guess that's what's meant by,
Yeah, I'm a little confused on that question as well. Whether bilateral.
Yeah, it is a bilateral credit. Yeah.
I mean, just from our perspective, when we see somebody trading an instrument, like it seems like folks will prefer exchange trading. So that would be cleared through an FCM wherever possible, if there is liquidity, if there's volume, just because it is so much easier. But a counter to the move to FCMs, and I think something Muneeb mentioned a second ago, having everything at one FCM, we actually see an increased movement towards people having multiple FCMs, because that's another sort of risk vector where, you know, maybe one could lock your account while you're trying to unload or capitalize on a position. So I don't know, maybe multiple FCMs is the new bilateral credit.
Yeah, and you know, I can maybe add something quickly. I think Samir is exactly right. I mean, having one FCM, that is the problem, right? All of a sudden you hit your limits on that FCM and you get locked out and you can't put in any more trades for maybe 15, 20, 30, 1 hour, minute. You know, it doesn't, whenever you get a hold of them and whenever they're able to enable or you know, take the restriction off. So definitely, I think Samir is right. Having multiple FCMs takes that risk away. But then there's an argument to be made for bilateral as well, right? Bilateral credit, because liquidity is low in the market, especially the more specialized you get on the products, right? The less liquidity you might find if you are in the market for options. I mean, the bid ask is extremely wide. If you know, so it depends on your strategy. If there's something very liquid, it often helps to have that relationship, some bilateral relationship with a corporation that's just always willing to step in and take the other side.
I guess that addressed the question hopefully by Solomon Schultz. Okay, now we actually covered the items within the agenda, and before you know, closing, what I would like to ask each panelist for a final word in like 1 to 2 minutes. Pierre, what's your key takeaway?
Well, I think it's important to secure the modeling framework from both a quantitative analysis perspective, right? So which quantitative models, which tools to use, and from a technical standpoint, as Samir and Muneeb have said earlier as well, you know, having a centralized place takes, you know, different technologies possibly to come together. Securing both the modeling aspects and the technical aspects is a key thing. Finding the proper tactical tools to react to the, you know, turmoil right now is probably quite important as well, rather than trying to, you know, focus some attention in trying to build that internally, because in these times of high risk, it's probably better to refocus the company on its core business and seek the help of some experts that can provide fast and tactical tools to help going through the turmoil period until the market stabilizes back.
Yeah, thank you, Pierre. Samir.
Yeah, just to sort of build on that, you know, one of the things that we at Molecule really have fun with is seeing new things about markets, permutations we never even contemplated, and seeing what interesting things people are doing. And so today's environment is so much more interesting than it was, say, 10 years ago. And, you know, communication is obviously very important, whether it's person-to-person communication or system-to-system communication. And we can't take system-to-system communication for granted, because that's not how systems have always been built in our industry. You know, what we see is that the technology needs to react quickly to changes in your business, sometimes even within a day. So, you know, maybe this is self-serving, but it's always helpful to choose modern tech.
Great. Muneeb.
Yeah, it's been a very interesting year, right? I mean, it's been multiple cycles in 1 year has been completely wild. A lifetime of learning in 1 year. And so there's a lot of takeaways, but I think the main takeaway would be to really just keep stress testing your books. Continue to improve risk modeling, right? And then continue to communicate between the front office, the middle office, and the back office with treasury. Margin calls had never been in focus before. It's just most companies had the amount of credit and all of that, right? Interest rates were low. Everything was fine. Now we have a high interest rate environment. We have, credit drying up. Everybody needs credit because everybody's inventory and cost of doing business has gone up. So it's a much more complicated. It's become a much more complicated arena, which now requires way more integration between the front office and especially treasury, and position management. And now banks want to know, what are your positions, right? What are your futures positions, and how what can we expect? Are you going to come and ask for a credit line increase, right? And so that's when actually I'm seeing traders are actually getting involved in those because they're sometimes the couple of that's part of the organization that can answer some of those questions. It's become complicated. So I would emphasize stress testing and communication.
Yeah, great. Those are quite interesting, actually. Takeaway: secure modeling framework, find the right tool to address the challenges, select experts, help, and of course continue improving basically your risk modeling. And the most important is communicate between different offices. Great. Thank you all. With this, we conclude the discussion. I hope everyone found it fruitful and beneficial by addressing its key points and covering the agenda items. Thank you all, and special thanks to the organizers and the sponsors and to our esteemed panelists. Thank you all.
Thank you.
Everyone.
Thank you. Thank you.